let's jump straight into this explainer. If you're trading the markets right now and need a terminal-to-screen breakdown of exactly what happened overnight, plus the tactical setups for major currencies and Indian equities, well, you're exactly where you need to be. We've got a lot of ground to cover, so let's get into it.
Right now, it feels like global markets are locked in this massive, high-stakes tug-of-war. On one side, the relentless, almost euphoric enthusiasm around AI. But on the other side, good old-fashioned, energy-driven inflation fears. Now, the market is super sensitive to both, but let's be real, inflation is definitely pulling harder on the rope today. Growth data is hanging in there surprisingly well, but it's finally dawning on everyone that this quote-unquote temporary inflation has stuck around long enough to start paying its own property taxes.
And you know, the data absolutely proves inflation is winning the narrative. Just look at last week. We saw this incredibly sharp, synchronized sell-off in global bond markets. I mean, the UK 30-year bond yield just ripped right past 5.8%. We haven't seen levels like that since 1998. Oh, and Japan's 30-year? It just crossed 4% for the first time since 1999. So the bond market is essentially screaming at us, aggressively pricing in the reality that these higher rates are not going anywhere anytime soon.
So, here's our game plan for today. We'll kick things off with a global macro wrap, look at the week ahead, dive into major FX technicals, and wrap up with Indian markets. We're literally funneling down from broad global risk straight into precision charting.
Starting off with Section 1, our global macro wrap, covering bonds, oil, and geopolitics. The big picture here is that the bond market is finally waking up to inflation, all while geopolitical tensions keep escalating.
Overnight, this macro reality really snapped into focus. First up, that synchronized global bond sell-off pushed the U.S. 10-year Treasury yield up sharply. It's knocking on the door of 4.6%, while the 30-year is parked firmly above 5%. Second, West Asia tensions have oil markets completely on edge, with the U.S.-Iran standoff totally stalling out, plus fresh drone attacks on Gulf energy infrastructure. The Strait of Hormuz is operating at very limited capacity, and that has spiked Brent crude right over $110 a barrel. Honestly, the scarier part, global oil inventories are falling fast after months of hidden drawdowns. Traders are out there refreshing headlines in pure panic mode. And hey, speaking of headlines, that Trump Xi summit in Beijing, lots of great optics, sure, but zero meaningful breakthroughs on Taiwan or getting the Strait of Hormuz fully open. Diplomatically speaking, it kind of felt like two heavyweight negotiators just carefully avoiding the dinner bill.
Moving right along to Section 2, the week ahead, with central banks squarely in focus. Let's look at the actual catalysts that are going to test these already jittery markets over the next few days.
So the whole week ahead really boils down to one massive question. Are these higher bond yields finally going to start breaking broader financial conditions? It's a packed week. We kick off Monday with Fed minutes and speeches. We're basically trying to read the tea leaves to see if policymakers are secretly panicking about how sticky this inflation is. Then on Tuesday and Wednesday, we get crucial pulse checks with U.S. housing data and PMIs, right alongside UK inflation and labor numbers. Thursday brings us China's trade and industrial data, and we cap off the week Friday with Japan's GDP figures. Listen, given the absolute stress in the bond market right now, every single one of these data points is a potential landmine for volatility.
All right, Section 3, Major FX Technicals. Let's take all this macro heat and translate it into actionable tactical levels, starting with the big currencies. Okay, so the fundamental driver for the US dollar right now is this structural energy shock inflation that's just violently pushing yields higher. I mean, both the US April CPI and PPI screamed severe acceleration. We're talking the hottest PPI since 2022, and the CPI just posted its biggest monthly jump since 2023. Because of this, the US 10-year yield is up a staggering 70 basis points. Think about that, a 15% surge just since the conflict started.
And that blistering CPI print translates perfectly onto our technical charts. Fueled by those hot numbers and the yield rally, the DXY smashed right past our key 99.13 pivot. So tactically, we are firmly in a buy on dips regime here. Looking up, your resistance is sitting at 99.64, while on the downside, you're going to want to watch for support to hold around the 9900 and 9860 levels.
Jumping over to Europe, it's wild because the fundamental picture is getting totally steamrolled by broader global sentiment. Get this, the German 10-year yield has surged 55 basis points since late March. That's almost a 20% jump, which actually outpaces the US yield rally. Because of this spike, the market is now pricing in an 86% probability that the ECB delivers a 25 basis point hike at their upcoming June 11th meeting. But, despite that heavily hawkish setup, this overarching risk-off mood is just absolutely punishing the euro anyway. So when we look at the euro's technicals, it just broke right down below that critical 1.1629 pivot. That shifts our entire tactical framework squarely into sell-on-rise territory. I mean, even with an ECB hike staring us in the face, the global risk-off gravity is just too heavy. If we do get a bounce, look for resistance at 1.1656. Immediate support on the way down is 1.1612 and then 1.1544 below that.
Moving on to the pound, the fundamental backdrop here is an absolute train wreck, quite frankly. You've got this chaotic political noise and worsening fiscal problems slamming headfirst into structural energy shock inflation. It's a highly toxic mix, and it's put 10-year gilts on track for almost a 25 basis point rise just this week, pushing up toward 5.2%. We haven't seen that since July of 2008. Right now, the market is aggressively pricing in about 70 basis points of Bank of England hikes through 2026.
And weighed down by those soaring gilt yields and all the Westminster drama, our technical sell-on-rise strategy is honestly working flawlessly. The cable has dumped nearly 2.5% in just 5 days. Seriously, any bounce you see right now should be viewed with extreme skepticism. Your upside resistance is parked at 1.3393, while we're tracking downside support levels at 1.3326 and 1.3265.
Now here is where things get really fascinating. The Bank of Japan is currently facing what I call a nightmare trifecta stress test. First off, they have a massive 300 basis point rate gap with the Fed. Second, surging import-driven inflation is forcing them to constantly revise their core forecasts higher. And third, their 10-year sovereign bond yield just hit a 30-year high of 2.71%. It's a total catch-22, because any rate hike from them right now paradoxically steepens their curve instead of stabilizing it. Because of that immense pressure from the rate gap, the USD-JPY chart shows the yen desperately clinging to pivotal resistance right at 158.78. You gotta watch this level like a hawk today. If we break above that pivot, it opens up a highly bearish structure for the yen, and targets will rapidly extend to 158.93 and 159.77. On the flip side, downside support is resting pretty narrowly at 158.48.
All right, bringing us to Section 4, our final segment, Indian markets, covering the Nifty and the Rupee setup. Let's see exactly how this global pressure cooker is spilling over into domestic equities and currency.
The overarching fundamental theme for India right now can be summed up in 2 words: imported inflation. And as we all know, imported inflation really doesn't respect personal boundaries. It is weighing super heavily on market sentiment. Equities took a hit, with the Nifty dropping roughly 0.19% to close at 23,643.50. But it wasn't just the large caps feeling the heat, the broader market really felt the pain, with small and mid caps noticeably underperforming. Though interestingly enough, IT stocks actually managed a 1.3% rebound after getting severely beaten down earlier in the week. With expensive oil acting as this huge fundamental drag on the economy, the technical setup for the Nifty is remaining a strict sell-on rise. Look, with U.S. equities closing in the red and global macro uncertainties piling up, any rallies here are basically just selling opportunities. Our key resistance zone is mapped between 23,812 up to the 50-week moving average at 23,950. On the downside, keep an eye on support stepping down at 23,576, then 23,439, and finally 23,260.
And of course, that heavy reliance on imported energy is just hammering the currency. With oil prices flirting with $109 a barrel, the rupee has been pushed to a fresh record low, closing out at 95.9650 against the dollar. All this costly energy has drastically blown out India's merchandise trade deficit to over $28 billion, and it's heavily accelerating domestic wholesale inflation.
Fueled by that massively expanding $28 billion trade deficit, the clear tactical play for the USD-INR continues to be buy on dips. Sure, if you look at the chart, it looks slightly overbought right now, but the underlying momentum is just undeniable. Immediate resistance sits at 96.18. Now, if it clears that, your target shifts aggressively up to 96.90. For entries, you're looking for dip buying support down around the 95.82 and 95.43 levels.
So I'm going to leave you with this final thought to carry into today's trading session. We've gone through the data, the soaring energy costs, and the technical breakouts. As global bond yields are hitting multi-decade highs straight across the board, the million-dollar question is something in the broader financial system about to snap? Or is this persistent, sticky inflation simply our accepted new normal? make sure you keep a really close eye on those key pivot levels we mapped out today, because how the market ultimately answers that question is going to dictate our next major trend. Thanks for tuning into this explainer, and stay sharp out there in the markets today.